You've written recently that market risk is not the same as economic risk. Explain that tension for me at the moment and what it means for your business.
Sure. Well, I think the first thing is that economics are based on data. So are jobs growing? Is inflation staying neutral? Do we have the right interest rate environment? Do we have the right GDP growth? Those are all very hard facts. I would say the markets take all of those into consideration, but they are also a reflection of sentiment. And markets obviously are trying to predict the future. So it's a little bit of a different, or you have to look at that and say there's also a lot of divergence of views that can start to come into the markets that may not actually be underpinned with economic facts at this time.
So speaking of some of the banks, they'll talk about the bad volatility, the good volatility. What kind of volatility did you experience in the last couple of months? And did it boost volumes? Was it ultimately good for you guys?
Well, so volatility generally has a short-term impact, a positive impact on our business, but long-term, you have to be careful that it doesn't erode investor trust and confidence, and therefore looking at longer-term over the IPO environment and the ability for companies to access capital. So we would say that volatility in the short term can kind of flesh out that uncertainty, can flesh out those different divergence of views, and that's natural behavior in the market. But you don't want it to be a sustained issue because then it makes it so that investors may not feel as confident to invest in the market.
So from the outside looking in, you mentioned IPOs. It's hard for me to draw a distinction between what is holding people back right now. Is it the macroeconomic background, the market shakeout of the last couple of months, or the government shutdown? Can you help us out a little bit? What is it?
Sure. Well, first of all, in 2018, the U.S. markets had 259 IPOs, and Nasdaq was very proud to have 186 of those IPOs come to us. So we had a very good year last year, and we look at the beginning of last year in terms of the listing applications on file to list on Nasdaq versus at the beginning of this year. We've actually had a 35% increase in the number of listing applications wanting to come to Nasdaq at the beginning of this year, which means even despite the really good environment we had, we still have even more companies looking to tap the public market. So I would say right now in January, the reason why you're not seeing IPOs is really much more in relation to the government shutdown than it is in relation to companies sitting on the sidelines.
So the pipeline looks good. There's two big names that stand out for a lot of people this year, Lyft and Uber. Have you been speaking to them?
So we don't talk about any particular candidates, but I would say we've talked to a lot of firms from all different industries, very large companies, as well as some of the small, great innovators of our day as well. And all of them are really excited and getting themselves ready to go into the public markets. They're very focused on making sure that they're ready when the government opens, they're ready when the market is receptive.
There's an argument building on the outside, and I want your insight into it, that for Lyft and Uber, the window's closing. Let's get it done in 2019. The option's not going to be there in 2020. What do you make of that?
Well, I don't think any of us can really predict the future, and I would say that companies go public when they're ready and when the market's receptive. Those are the two things that they're going to look at. And honestly, in any given environment, if strong companies can come to market, even in the volatile environment in the fourth quarter, we had some really interesting and very strong companies come to market and do quite well.
So you think if the two big names do eventually list with you guys, that'll set the tone for the rest of the other players in the private markets?
So we're happy to have every single company list on Nasdaq.
You're not going there, are you?
We're ready to have them all come our way.
Can you talk to me about the breakdown of your revenue at the moment? A couple of years ago, I think the breakdown was about 30% on volume and 70% on recurring revenues, subscription basis as well. Has that shifted over the last couple of years?
Yeah, so today it's about 25% on volume and 75% on recurring revenues. And partly that's because of the fact that the recurring revenue businesses generally are higher growth businesses for us. Yeah. And partly because of some bolt-on acquisitions we've done in these kind of subscription basis, the data and analytics and technology businesses. But the overall in the first 3 quarters of 2018, all of our businesses grew, and our volume businesses grew basically in direct relation to our non-recurring.
On the volume business, you might get a bit of competition soon. Some of the big banks are banding together to create the members exchange. What do you think about that?
Well, it's probably good to put it in context. So today there are 4 large exchange groups that trade all U.S. equities. So we trade New York stocks just like New York trades our stocks. So there are 4 large exchange groups that trade and 35 dark pools that are really single dealer platforms. So we compete very vigorously every single day. We have a lot of those clients that are signed up to do something like MEMX are also our largest clients, but they also have their own dark pools. So this is very much a co-opetition type of environment. We are very good at what we do. We're very proud of what we do. This is the 6th time our members have made an attempt to launch an exchange.
You don't sound concerned about this at all.
We're really not. We feel very ready to compete.
Adena Friedman, black belt in Taekwondo as well. Are we going to go one step further there too?
I am working on my 2nd degree, but we'll see how it goes.
There we go. Good luck with that. Adena Friedman, the CEO of Nasdaq.